compassion, that you're current with the laws. And so I see CPAs in practice all the time that are totally clueless. They're disorganized. They don't have attention to detail. They're not current in the laws. Also, I see it with estate planning attorneys. I mean, it's atrocious. And then I'll see people that don't have fancy credentials, but they're taking these courses that Jeff and I are teaching. They're reading up on it. They're lifelong learners, and they can go out there and do tremendously well. So yeah, do I believe that people should have a lot of credentials? Sure, that's great. But you don't have to have it. It's not a sine qua non. I would tell you, if you take these courses, follow the savvy.
There you go, using legal terms, Debbie.
I had to throw a little Latin in just to keep it spicy, Jeff.
Mm-hmm.
This can be done. And let's be honest about it. I mean, Jeff and I are both CPAs. They didn't teach any of this stuff in CPA school, whatever that is. This is not stuff that I learned 25 years ago when I sat for the CPA exam. These are all things that I'm learning and teaching myself now. And so, sometimes, people get a little bit like intimidated, or they'll use it as an excuse not to move forward in a certain area. But at the end of the day, everything that Jeff is doing now, everything that I'm doing now, this is all stuff that we are learning as we go and teaching ourselves as we go. And there's no reason then that anybody out there, can't be doing the same thing. So those are some thoughts.
I'll chime in with, I don't know that I disagree with anything that Debbie said, because I think she's right on the numbers, that none of this is stuff that you learn in as a CPA or in law school or, in any course, candidly. But I will say this: if you're an advisor and you're serious about your craft, then I think it's worth looking at what makes others believe that you're serious about your craft. So I kind of look at the CFP as a baseline for advisors today. I think the future, everyone will, if in order to be taken seriously, you're going to have a CFP or something equivalent. I'm not saying it's the CFP, but right now, that's the designation that, when consumers, whether whether you agree that the CFP is the best training or not, when you're looking at consumers saying, who do I trust in financial planning? More often than not, they're going to ask, are you a CFP? They've done a good job at their advertising campaign. So I would say a CFP, if you're an advisor, is really something you at least want to consider, because it is the advisor. It's the most known advisor designation. Do you need to be a CPA or a JD on top of it? I don't think you need that at all. I don't know that there's a material impact in my career from a client perspective. That the fact that I have a CPA or whatnot, does it make some things a little bit easier? Yeah, because you can always have a tax practice as opposed to your advisory practice, so you can be giving tax advice as opposed to just tax education. So it does make some conversations a little bit easier. It'd be insincere to say that that's not true, but I don't think you need any of those. I have tons of friends in this business who have had incredible success, and they don't have a CPA, they don't have a JD. They probably, most of them have a CFP, but not all of them. Some of them don't. Some of them have gone other ways. Some of them are CLU. Some of them just old school. They got nothing. They were really into learning on their own, and they built up enough of a client base. But it's different. The business is different today than it was 20 years ago, 10 years ago, even. I think today people are more aware while they're shopping of what education options are available to financial advisors. I think, look, even the CFP board in general, years ago, you didn't need to graduate from college in order to be a CFP. Now you need college credits. You need you need your degree in order to become a CFP. So I think the bar for entry to the business is being nudged higher. And I think it will continue to nudge higher, and it should, candidly. The barriers to entry to this business, in my opinion, are too low. Are too low. It's too easy to look somebody in the eye and say, yes, I am legally qualified to tell you what you should do. Passing the 66 or the 60, the 65 or the 7. Does anybody really think that alone should qualify you to sit in front of someone and tell them what they might want to do with their life savings? I would submit not. I certainly wouldn't want to be on the other side of that table if I was a client. So just some other color for you there.
And so Randy just commented in. So I've listened to Debbie on several occasions. In my opinion, while her credentials are definitely a benefit, the most important factor that contributes to her success is her enthusiasm and confidence in her ability to provide the client with tremendous value.
Agreed.
Yeah. I mean, that's kind of you, Randy. So thank you. And I think that's true. So again, just to not to beat the dead horse, do the credentials help? 100%. And I will tell you, probably without my credentials, I would have been out of business, because for the first 20 years, you know, who gives money to a woman to manage? I mean, I was definitely in a minority, and my credentials helped me to compete, to be completely candid about it. So I'm thankful for my credentials, and there's never a moment that I hide them. But having said that, yes, you should try to go out and get credentials, but also don't hide behind the fact that you don't have them. If you do this learning and you have the confidence and you have a great service model, like, you can succeed in this business. But the credentials definitely help.
Okay, let's move on to our next question, which is coming from Ira. What's the best way to determine if a non-qualified annuity is a better alternative than a taxable portfolio of indexed ETFs if for a high marginal tax rate?
Well, some of that is going to depend upon what you believe the future holds, right? So there's potential changes coming along this year that could have a significant impact on whether we think one is better than the other. For instance, loss of a step up in basis, if that does happen, which is part of the Biden platform, that might materially change things. Now, having said that, how do we, what's the best way to look at that? Your trade-off, right? You've got a trade-off. You're basically exchanging ordinary income for capital gains, or capital gains rather for ordinary income in that place, but you're getting deferral. So it's, I would say more often than not, when you factor in costs, unless you're looking at investment only VAs, the costs there are going to be a little bit challenging in many instances. But if you're looking at investment only VAs, I don't know that there's a particular breaking point, if you will, but there are other factors to consider. For instance, how important is creditor protection? If creditor protection is particularly important, the annuity wrapper may provide more of that. And in many cases it does. And in many cases, your high income, high net worth client is more concerned with creditor protection than is your client with less income and less assets. So there may be reasons there. We could also look at how often are you going to be rebalancing that, that indexed ETF portfolio. All these, these are all factors that have to be accounted for. The more you rebalance, if you rebalance quarterly versus semi-annually versus annually versus we just let it run and we see what happens, these all impact what you should be doing. Client's income tax bracket impacts it. For instance, if the client today is at the 35% ordinary income tax bracket, what's their long-term capital gains bracket? 15%, right? Today, right? It might change, but today it's 35% versus 15. So there's a huge delta. If your client is in the 22% bracket, right, and then they have a long-term capital gains rate of 15%, it's not nearly as big. Still 7% is, it's a lot of money, but it's not nearly the same as 20%, right? It's a third as much. So we've got to look at what the individual factors are there. Overall, what I would say here is this, is that when we're looking at these things, this is where if you don't do tax projections yourself, you might want to loop in the client CPA or utilize some of the, utilize software to do this, to throw some projections out there yourself. You could do that. Notably, Horsesmouth now has we had now an agreement as part of the Savvy Tax Planning Program with Holistaplan. So there's an excellent opportunity to do that as well. There's, ability to run scenario analysis there where you can just plug in and say, okay, what happens here versus if I do this? But just recognize that these things change. There's an answer today, but that answer may not be the same literally in 6 months from now when the Biden tax plan is moved through Congress, which I assume we will get some tax plan. To the extent to which changes are made, I think that's still up in the air, but I would be shocked if we ended 2021 without major tax legislation passing. Debbie, anything you want to add there?
Yeah, I mean, look, these are the eternal questions that everybody's always trying to answer. Like, I had one of my clients yesterday forward some ridiculous article to me from Business Insider saying that Roth IRAs, Roth conversions are not a good idea. And it was this just incredibly superficial, lightweight article. and I basically just tore it apart. But at the end of the day, it's the eternal challenge. Do we do a Roth conversion and pay taxes now so that we don't pay taxes later? Do we do an annuity to defer income now, but then we've got to pay at our ordinary income tax bracket later? And the problem is that none of us have a crystal ball. And so part of it is you've just got to look to see maybe hedging some of these strategies. If a client's really concerned, maybe you do a little bit of this and a little bit of that. Or like we say, we use the tax software now. So in the old days, it was sort of very philosophical or back of the envelope. And now, like Jeff's saying, there's, whether it's Holistiplan or you go into eMoney, and you can start running some scenarios for clients and start putting in some assumptions. But remember, garbage in, garbage out. You still don't have that crystal ball. You might have great technology, but you still don't have a crystal ball. And so there, you have to accept a certain amount of imperfect information when moving forward with these recommendations, and basically pick your poison. And that's what I say to my clients when they push back on a Roth conversion. I'm like, you've got to pick your poison. You're going to either pay taxes now at a very predictable level, and in exchange for that, you will have tax-free income coming down the road, and you're not going to have to worry about the government being a silent partner to you in your traditional Roth, IRA, or not. But you basically got to pick the thing you fear the most, and then do what you can to avoid the thing you fear the most. So those are my thoughts.
Yeah. And that will change over time. I mean, I'll just add one other thing with the Biden tax plan potentially coming. One of the elements here is that death would cause a sale or a perceived sale, right? A realization event of all gain. And if you've got this portfolio that's, been growing for the last, 20 years or so, it might have a lot of gain inside it, right? Could be more than $1 million of gain in some cases. And the platform also says if there's gain and you have income above $1 million, that gain would be taxed as, ordinary income as opposed to long-term capital gain. Well, if that was going to be the case, having that income or having that, investment inside an annuity would make a ton of sense, right? You would avoid that and you'd be paying the same rate anyway, just down the road. But we just don't know, right? So every client situation is different. You've got to, I think Debbie put it well, pick your poison, but realize that the poison, the dose, if you will, changes from time to time. I just can't I just think in my mind now, the Princess Bride, right? Where they're both poison. Debbie, do you know the Princess Bride?
Yeah.
Yeah. It's like, aha, they're both poison. I just have an immunity to,
Well, that's, it's a great metaphor to be using, particularly these days. And let me hop on that one. And so one of the questions that just came in is, looking forward to Biden tax proposals, what are some things that we recommend? And so I'll mention, one or two things, and then Jeff can mention one or two things. So it's interesting because I just got off the call with the client and their tax preparer. And the client is worth about $15 or $20 million. And so we set up some grats last year, the last week of December, because I just was totally paranoid. And so we didn't go overboard, but we set up some modest grats just to cover us a little bit. And so anyway, we're talking about some taxes. And so they have stock options that they need to basically sell this year. And so they're saying, we're going to get taxed on that. It's $1.5 million of tax options. It's like this final tranche. And I said, look on the bright side, better that they're forcing your hand this year when the highest tax bracket's 37%, because if they didn't force the hand or they had more tranches coming due in future years, they might have dragged their feet a little bit, and then they would have been taxed, at a much higher level. And so I will throw into the ring, because the person had a question, what are some strategies? So I will throw into the ring that for some of these clients who have over $400,000 of income, and again, not clear whether that's joint or single, which is sort of a big thing for all of us to be fuzzy about, is those higher income clients definitely consider accelerating income into this year, consider accelerating sales into this year, knowing, of course, that the capital gain issue is $1 million of income or over. And I think a lot of people forget that distinction. So that higher capital gains rate is only if you have $1 million of income. But if that's a sale of a business or large stock transactions or whatever, I would definitely encourage considering moving that into this year versus waiting until 2022. So those are two things that we're working on for clients as recently as an hour ago. Jeff, some other, and of course, estate planning, right? Of course, estate planning. And so, again, not clear whether it's $3.5 million or about $5 million plus per person. And so basically our rule of thumb was that if you've got a client that's worth over $11 million, 10 or $11 million, I was doing what I could to chip away at that, which is what, some of those grats going into play last year. And so definitely keep an eye, on that. And again, we don't have a crystal ball, but I think a lot of us would be surprised if there wasn't tax legislation effective as of 2022 at the very least. So those are some thoughts on that question. Jeff?
Yeah, I think I'll start with the last point you made. I do think that the fact that we're starting with more stimulus and then we're looking at more infrastructure, I think ultimately you're going to have to, the Biden team has talked about including tax legislation with the infrastructure as part of round two. I actually think ultimately those will get decoupled because I think they're going to have to pass tax legislation via the reconciliation process. And you can't do that with other non-revenue related provisions inside the bill. So I think they'll get decoupled. I think tax legislation gets pushed out later this year. And the more we get pushed out later this year, the less likely, one of the common questions I keep getting is, are they going to retro this to January 1st of this year? The further out we go, I think the less likely that becomes. And while I too don't have a crystal ball, at this point, I would really be surprised if anything went retro to 1/1/21. I think we're almost certainly looking at a 1/1/22, which means the rest of this year, we've got some interesting opportunities. Well, look, for instance, you go down the list. Debbie talked a lot about the estate planning side. If we look at the ordinary income tax planning side, if you've got clients at the very high end of the spectrum, 37% or higher, looking at things like Roth conversions this year can make a ton of sense because we're accelerating income to a lower rate than would likely be the case in the future at 39.6%. Now, the Biden platform calls for that cutoff, that breaking point, to be $400,000 of income. It's not clear whether that applies to single filers or joint filers or both, but that could potentially shift income from 32% to 39.6. That's a big jump. That makes potentially the reward for someone in the 32% bracket today, a joint filer, much bigger than someone in the 37%. The problem is we don't know yet what final legislation looks like. Just because, President Biden, now I don't have to say former vice president, president-elect. Now I could just say President Biden. It's easier. President Biden, his proposal is $400,000 of income. But just because he said that's what I want doesn't mean that's what he gets. It's important to remember here that the Senate is 50-50 right now, right? With the independents who caucus with Democrats and the Republicans, right? That 50-50 split, which means you need every single vote on the Democratic side to say yay in order to push that to the tiebreaker to get to Vice President Harris to cast that deciding vote. Well, we've already seen overtures from purple state Democrats like Joe Manchin, for instance, who've said, well, we've got to be careful about spending. And so I think there will be significant changes to the Biden platform. What they are, I don't yet know, right? None of us know. But I think there are likely going to be some material changes. They won't be able to be as progressive as he may have wanted, because they are going to need to bring along every single purple state vote as well. So just one person could derail that whole thing if there's something in there that's too progressive for what they feel they could bring to their own constituency. So having said that, Roth conversions at the high end of the spectrum make a ton of sense. If you're at a more moderate, like 35 or 32% range, your potential reward this year for converting could be much higher, but your potential risk, if they actually push the top rate, let's say the top rate stays where the break is today at 620,000 or whatever for joint filers, well, then actually converting today would be worse. So I would hold off on those conversions right now until we've got some more clarity, which I expect we'll have by the end of the year. Now, on the capital gains tax side, once again, I think we've got to see what gets included in this bill. Is there an elimination of the step up in basis? That totally changes the game. Whereas today, you want to make sure you hold on to assets and die with them so that you get a step up in basis. If there is an elimination of the step up in basis, the last thing you want to do is die with the assets, right? Then maybe we want to be looking at funding trusts that don't die, or gifting there's all sorts of things that we might want to look to do. Even things like deductions. Right now, we're at a very high standard deduction. The Tax Cut and Jobs Act roughly doubled that. If clients are looking at giving this year, let's say to charity or next year, and like 90% of the filers, they are taking a standard deduction, have them push out those gifts to January of next year. Worst comes to worst, they don't get a break, just like they don't get a break this year. But if there is a change, they might actually benefit from that. So there's all these kind of what ifs scenarios. Once we get some more final tax legislation out there or draft legislation, I think we'll be able to come out with much more pointed guidance. But if I were to summarize everything at very high level, it's on the estate tax side, we're looking at shifting assets outside of the estate this year while you have a high exemption. On the income tax side, it's accelerating income for those at the highest bracket. On the capital gain side, it's looking and saying who might have income in excess of $1 million, not just now, but if we forced all their assets to be sold upon death. And if that's the case, how do we mitigate that? Those are kind of your high level issues. And then of course, there's all, I mean, we could spend the next hour just talking about the Biden tax plan, but then there's all the other ancillary things. Candidly, I think the biggest change that would apply to the greatest number of your clients, if implemented, would be replacing the current deduction for traditional IRAs and 401ks with a flat credit. That would be a game changer. In fact, it would literally flip the current retirement savings paradigm on its head. So for those who aren't aware, part of the Biden tax platform was replacing the tax break, the deduction we get, or the salary reduction if it's a 401k, for traditional style retirement accounts with a flat credit. And the way the credit would be implemented would be as a revenue neutral credit, meaning, you know, the estimate is about 26%. That's what the credit would equal, meaning that everybody who puts money into a traditional IRA or uses a traditional 401k would get a 26% credit. So you're in the 12% tax bracket and you put $10,000 into a 401k today, it's a $1,200 tax savings, right? 12% times your $10,000 contribution. Do it with a 26% credit, it's a $2,600 benefit. It's more than twice as much. Well, how does that get offset to keep it revenue neutral? Well, someone who's at the 37% bracket today, who puts $10,000 in, sees their tax bill drop by $3,700. If we had a 26% credit, instead of seeing their tax bill drop by $3,700, it would only, quote unquote, drop by $2,600. So that's kind of how it would even out. It would hurt those at higher brackets and help those at lower brackets. But it actually completely changes the paradigm. Today, those at low brackets, we generally encourage to do Roth contributions because what's the value of the deduction if you're in a low bracket? It's very low. But if you get a credit, you know, put $10,000 in at the 12% tax bracket, not only are you offsetting the the tax bill on the $10,000 you put in, but you're offsetting the tax bill on like another $10,000 of income. Whereas someone at the high end, let's say in the 37% tax bracket, does that if they're only getting a 26% credit, but they put $10,000 in, well, it means they still have a $3,700 tax bill minus the $2,600 credit. That's a net $1,100 tax. That's before they even raise the top bracket, by the way. That net $1,100 tax continues to be paid today. But what happens when they take the money out in the future? Well, it's still a pre-tax account. It's not a Roth account. It's still pre-tax, which means they pay income tax again, meaning that your top rate could literally be the 39.6% minus 26% credit of 13.6% now, plus another 39.6% later, which effectively would mean that you would have Roth contributions as your standard for high income individuals and traditional contributions for your standard for low income individuals. And that is exactly the opposite paradigm that we have today. So we have to wait and see whether that becomes part of the law or not. Traditionally, retirement account changes have been a third rail for politicians. So will that or won't that happen? Don't know. But that would be the single most impactful change kind of across the board for the greatest number of your clients, I believe.
Okay. Great. Let's move on. Let's move on to another question here. So we got this one in before we started this session. Does Debra do tax returns for clients? And if so, does she charge, or is that included as a value add? Does she have additional tax pros on staff?
Yeah, I mean, that's right. That's like a whole other section to talk about. So I've gone through a fair amount of evolution because I started actually doing tax returns as part of my family's tax practice. My father was a CPA. So I started truly as a tax professional. Then I had both businesses running side by side, which was honestly very difficult to do. And then I sold the tax practice and continued, though, doing some tax returns for top clients, and then completely phased it out. So I've sort of like the evolution of like some type of like amphibian or something. And so I would tell you right now, I do not do tax returns. I felt like it was very difficult to serve a number of masters. I know people that do it, and they do it very successfully. But I just didn't do it. And honestly, over time, preparing tax returns has become very commoditized in my view. And so to me, it was just sort of this whole other part of a practice that I could develop that honestly, I didn't feel like had tremendous upside. And so we actually have a referral relationship with the CPA. He does not do any investment work. We share the vault, a lot of communication back and forth. And that's actually worked out very nicely for the client. So I don't know if that answers the question. There was a time where I did it as a value add. So for those top clients, I would include the tax return as part of it. And I know a lot of people that's a big part of their business model and it's very successful. I personally just felt like I was getting pulled in a million directions. And then what happened is during tax season, it was very distracting. And I couldn't like take off from wealth management for 4 months of the year. And so anyway, so I stepped away from that part of it. So hopefully that helps to answer that question.
Okay, great. And Carl has asked, so you use Income Solver. Any feedback on Retirement Analyzer?
Yeah, we use Income Solver in the office, and somebody mentioned in the questions that there's a fair amount of like detail and input involved. And so one of the bits of feedback I'd give is that for those simpler clients, I would just stick with Holistiplan and trying to figure out like a Roth conversion strategy for going forward. We basically hold back Income Solver for those more complex clients that have like $1.5 million to $2 million in their traditional IRAs. That to me then justifies, creating sort of this 5-10-year plan through Income Solver and all the input involved and all the analysis. And so that might help you. I don't have experience with Retirement Analyzer. But that's how we handle the Income Solver, because it is a little bit of a bear, to try to put every client in that. And it doesn't make sense. It's too, it would be overthinking the problem, to do it for every client.
Okay, and moving right along then, Hubert's got a question. Jeff, you might have already touched on this, but he asked, Jeff, what should we be expecting from Savvy Tax, as it looks like people with high amounts in qualified plans looking to move to a tax-free environment?
Can you repeat that question one more time? I'm not sure I understood the question.
Yeah. Jeff, what should we be expecting from Savvy Tax, as it looks like people with high amounts in qualified plans are looking to move to a tax-free environment?
Yeah. Debbie, do you understand the question? I'm sorry.
I think I do. I think they're wondering, Jeff, the types of recommendations that we might be including. And I think Jeff handled a lot of that indirectly by talking about the Biden tax plan before. There's more of an emphasis on these Roth conversions, like Jeff mentioned. That should be front and center in everybody's arsenal, is trying to at least create tax diversification. And a big part of that tax diversification would be those tax-free accounts with those Roth IRAs. And then, of course, again, I think Jeff basically addressed a lot of this, and I addressed it a little bit too, is under the Biden tax plan, if some of those things come through, what's the type of planning we're going to be doing for clients? Obviously, that's going to find its way into the Savvy Tax program.
Yeah, I mean, as soon as this goes live and we have a bill, we'll be on the horn kind of with an emergency update program to say, hey, this is what's going on. Look, if rates continue to go up, you're going to see a lot of changes. Roth conversions are going to be more recommended. You could see, as we talked about earlier, investment-only VAs being more valuable. You're going to see skewing certain investments. So for instance, right now, dividend-producing investments, people may not mind them as much given current rates, but if rates continue to go higher, all dividends are forced sales of investments. Clients have a misconception, if you will, that dividends and interest are essentially like the same thing, and they're not, right? Like interest is pure, here's new money. Thanks for borrowing, like thanks for letting us borrowing yours. Here's new money. Dividends are just from, money that the company already has that they're distributing. So if you can shift to growth investments, then you minimize the tax impact there. Could be that you look at municipal bonds in greater amounts going forward. All of these things. Could be even looking at things like life insurance as an asset class in some cases. I think primarily people should, I think in general, people want to look at filling up their tax deferred buckets first, if you will, things like, traditional IRAs, Roth IRAs, 401ks before they look at life insurance as an asset class. There are some exceptions to that, but I would say that's the general rule of thumb. But once you've done that, then for your high income clients, that that can certainly make sense as another tax-free vehicle. And look, if tax rates go up, the break-even point goes down. So there's a lot more that can be done there as we move forward and we look at potential higher tax rates on the horizon. Even things like helping your business owners create structures with regard to sales, as opposed to selling their practice for cash in 1 year, where that might spike their income over that $1 million threshold that's proposed. Maybe we want to look at things like installment sales, et cetera. Like there's lots of little things like this where we want to take advantage. Again, assuming that those changes come to pass, and when they do, we'll be able to make a little bit more educated decisions as to what to do with clients once we know with to a greater level of specificity what those changes might look like.
Okay, let's move on then to Jonathan's question. Does filing separately impact Social Security claiming for spousal benefits? Married filing separately is becoming a common strategy to deal with giant student loans. I'm encountering it with a client, and I've had a hard time finding an answer on this.
Debbie, you want to take it or you want me to take it?
You can take this one.
No. The answer is no. So that's it.
Yeah.
Okay.
I didn't see that was an issue either way, so I didn't know if I'd missed something.
No.
Let me take one or two of these. So Huber is asking about the article, verbally or written. Yeah, I just totally tore apart that silly little article. And so I'm happy to share with you what I wrote in advance. Just send me an email, dtaylor@taylorfinancialgroup.com, and I'll forward it to you. But I'll forward you the article and what I said about it. No problem on that. Let me just grab one or two of these quick ones. There was a question before Jeff got on about IRMA and how the income is defined for IRMA. So it's MAGI, right? Modified Adjusted Gross Income. It does not count Social Security, but it does count tax exempt interest. And so it doesn't count Social Security, but counts tax exempt interest. And so obviously you're adding your AGI to that. And so I wanted to answer that one real quick. And then there is a question again before Jeff came on about Section 127, student loan relief. Can those checks be made directly to the employee, or do they have to be payable to the institution? It could be done either way. So the check can be paid to the employee as long as it's for a qualified education loan incurred by the employee for education of the employee. And so it doesn't count for the employees like family, but it does include tuition, textbook fees, et cetera. So anyway, just wanted to knock off those two questions real quick.
Okay, great. And let's see. Edward has asked, can you explain when RMD is due if the person turns 72 in 2021? I believe it will be 2022, but I just want to make sure.
Yeah, so if a person turns 72 in 2021, right? That was the year?
Yeah.
Yeah. So if a person turns 71 this year, they'll be 72 next year. So they would start their RMDs next year in 2022. If we go back to last year and we say someone turned 72 in 2020, that's a common question I'm getting still. Hey, I turned 72 last year in 2020, but I didn't have RMDs last year. What happens this year? Do I start, as at age 72? No, you don't. You just pretend as if you took the age 72 RMD and you take your age 73 RMD this year. And it does need to be done by December 31st this year. You can't push it till You cannot push it to the following year like you can. You can't push it to April 1st, 2023. It's considered that you took your first RMD, if you will, last year, even though there was no RMD for that time.
Okay. And let's see here. So Jonathan has asked, is it fair and reasonable to look at post-World War II federal income tax rates as they correlated to national debt versus GDP and our debt GDP ratio nowadays?
Yeah, I mean, I don't know exactly what the question is here, but I mean, I think it's fair to do that. We're seeing those comparisons all the time. I think the challenge is that we had a very strong growth post-World War II, which helped to pay down that debt. And we had more political will to cut spending. And so to the extent that we're seeing those comparisons, I think there's a little frustration because even though our debt and our deficit are at wartime highs, we don't have the potential growth coming out of this or the political will to cut the spending, which is problematic. So that's just initial thought. Let me just pop in here for these one or two other questions I'm seeing to bang them out. Is Jonathan asked about pulling RMDs out incrementally over the year, like a DCA strategy, or all in one lump sum? And so I just want to say, Jonathan, this is a tricky one because it goes back to this whole crystal ball thing. I mean, if you look at sort of like longitudinal analysis, right? The longer money stays in an account, the more that account will grow. And so that would then argue to deferring those RMDs to come out later in the year, because if you do that every year over a period of 20 or 30 years, then you're allowing those accounts to grow. It's the same argument in favor of taking or contributing to that IRA as soon as possible. Some people will wait, literally, it adds up to almost a year and a half because they'll do it April at tax time instead of January, in the previous year, right? Instead of doing it now in 2021, they'll wait until April of 2022, and they think that they're being really tricky. But what you're doing is you're losing that deferral and that growth, for a year and a quarter. And if you do that every year over a period of 20 to 30 years, it actually adds up. And I've seen the data on that. And so that would argue in favor of taking your RMD later out in the year. Of course, your cash flow needs to allow for that. And then you always have to account for the fact that if you decide to take your RMD out in October, November, and then the market crashed that month, now you're taking even more money out of a depressed account. And that has, its own issues. So, and again, those are just some thoughts on it. Basically, what we do for clients in the office is that if they really need that sort of even cash flow, and some clients really like that, they get their Social Security check, they get their pension check, and they get their monthly RMD check. And if that feels comfortable for them, then that's something we'll do. But we also have a whole slew of clients that we don't take RMDs out until the end of October or early November. For this exact reason we're talking about here, is we want those accounts to grow as much as possible. And so anyway, that's just some thoughts there on that one.
Okay, great. And then moving right along then, Robert has asked, help me understand how you can recommend loading up 401ks and IRAs when we know that tax rates will be going higher.
Well, if you are looking at if you're looking at this from a perspective of tax rates going higher, if you believe that, and I certainly am more inclined to sit in that camp, that it's not, I guess too often what I hear is, oh, you shouldn't use retirement accounts because tax rates are going higher. Well, if that's the case, don't use traditional retirement accounts, use Roth accounts, forego the deduction today. I don't think anybody here is suggesting that, people should put all their money into traditional accounts. Certainly, let's say someone is in the 37% bracket today and they make $650,000 of income while they're working, and in retirement, we think they'll have $200,000 of income. Well, you've got to not only assume tax rates are going to go up, they're going to go up a lot in the interim in order for that to, in order to make sense not to go the traditional 401k today, right? Even if you raise taxes across the board 20%, if you're in the 37% bracket today and you go to the 24% bracket in the future, even if you increase the 24% bracket by 20%, so you're up to 30, you're still better off taking the tax break today at 37%. And paying it later in the future at 30. So you've got to see a significant drop in those tax rates. But if you think your client's income will be relatively stable throughout, yeah, that absolutely bodes for not using traditional style accounts and going the Roth route and making sure that you have what I like to refer to as tax insurance. With insurance, you drive your car, but you don't hope you get into a car accident so your car insurance pays off. Same thing here. You can have Roth accounts, and you do it because you're worried that tax rates will rise. You can hope they still go down in the future, but if they don't, you've got insurance. You've got tax insurance in the form of your Roth IRA. So just something to think about there.
Okay, and this one might be more geared towards Debbie. So I set up an LLC for my business. I would like to bring a CPA or EA in-house. How would I go about looking for one, and what business arrangement would you suggest?
Yeah, I mean, look, yeah, I mean, Doug's laughing, right? I mean, it's only limited by your imagination. And so how to go about looking, I mean, there's a lot of underemployed tax preparers, people that, work as bookkeepers that want to be doing this. It's actually, the CPA profession's interesting because it's this like weirdly fluid per diem type profession, and you don't see it as much in other professions. And so, yeah, I mean, there are people floating around. You could check, just putting out regular ads, your network, the AICPA, just like you would try to find, anybody else. As far as arrangements, when we had people coming in per diem, we would sometimes pay them by the hour. We'd pay them by the day. There are times where we'd pay them by tax return, but that's a little tricky because then their work could be sloppy to just trying to churn out tax returns. We typically would pay by the hour, is how we would handle it. And so those are just some thoughts on that.
Okay, so we have a question in from Scott, and Jeff. I don't know if you have the Q&A field up here, but you might want to read this one along with me here because it's kind of a long one.
It's at my computer, which is away from
Okay.
where I am.
Okay.
I'll have to listen, but while you prepare to read that, I just want to circle back on something that Debbie was saying earlier,
Sure.
just as just to clarify what Debbie was saying when we were talking about IRMA. IRMA includes your Social Security that's already a part of your AGI, right? Not your full payments aren't included in there, but to the extent you have enough, to the extent your income was high enough that you already had Social Security benefits included, that would be part of your your MAGI calculation for the IRMA. I just wanted to clarify that in case it was.
Yeah, thank you, Jeff. Thank you.
Yeah, no problem.
Yep. Okay, so here's Scott's question.
Okay.
Wouldn't charitable contributions need to be excluded from any 28% of AGI itemized deduction limitation to avoid destroying charitable organizations, since a 30% AGI donation of appreciated securities would already exceed that proposed limit?
Okay. Well, two questions there, right? So let's start with the technical element, which is the 30% is already above the 28%. Those are two separate things, right? So the 30% AGI limit says you can only deduct up to if your income is $90,000, if your income is $100,000, you can only deduct $30,000 worth of appreciated securities that are donated, right? Now, what the value of that deduction though is still up in the air. Depends on what your tax bracket is. So those are apples and oranges. The 28% cap proposed by Biden is limiting the value of the tax benefit, whereas the 30% cap on appreciated securities is limiting the gross amount, not the value, the gross amount of your deduction. So if you're in a lower bracket, let's say you're in the 12% bracket, right? Your net savings today is, or you know what, let's do it at your very high bracket. Let's say you're in the highest rate of 37%. Today you give away enough appreciated securities to get we'll make you $1 million of income, and you give away $300,000 of appreciated securities, right? Just because this will make our math easy, that's all. So $1 million is your AGI. You give away $300,000 of appreciated securities. Your value of that deduction is going to be today $300,000 times 37%, right? So that's a total of, if I'm doing math correctly, $111,000 you would have as a reduction in your tax bill, the 30% times 37%, right? Your 30% of AGI, $300,000 maximum deduction amount times 37%, the maximum value of each of those deductions. So 37% times 300,000 is $111,000. That's what your tax bill would go down. If the Biden proposal were put into effect, it doesn't change the 30% of AGI number. It just means instead of getting 37% times your $300,000, you'd be limited to 28% times your $300,000. So there, instead of the $111,000 reduction in your total tax bill, you would only, quote unquote, see, what is that? That's 28 times 3 is going to be 83% deduction, sorry, 84% deduction, reduction in your tax bill. So 84,000, right? So it cuts off that additional amount. And that's, that's rather significant, right? When we're looking at, or 86,000, sorry. But that's, that's your, that's the difference there. It's not the 30%, the 28% cap is not on the amount, it's on the percentage, your tax rate. Someone today in a lower tax rate doesn't care, because if you're in the 12% tax bracket, you're only getting a 12% times your deduction amount value of the deduction to begin with. Hopefully that explains that. Okay.
Yep. Okay. So
Like,
let's move on. We did get a question just in from Chuck. Is there any truth to the news report that Biden is proposing charging capital gains annually in brokerage accounts, regardless of a sell?
Yes and no. So it is not true that Biden is proposing that. It is true that it has been proposed. Notably, I think Senator Wyden has been a chief proponent of this. And effectively what they're calling for is mark-to-market pricing on your securities. I don't see it happening, candidly, for no other reason than it would be a giant pain in the butt for most taxpayers to comply with. And if anything, it could be something that is applied only to the extreme wealth, extremely wealthy. But I don't believe that will happen. It's not part of the Biden tax platform, but it has been proposed several times. It's never really made it very far, but you never know. So we'll have to keep our eyes and ears open. But again, not something that Biden has pushed for himself.
Also, again, as a reminder, remember that they have, a slim majority. So any of these more disruptive proposals, are going to have a difficult time even getting through the Democrats, let alone the Republicans. So just always keep that in the back of your mind.
Okay. We have an anonymous question. Is there a best practice or software you use to determine the most tax efficient way to pass assets to beneficiaries?
Maybe you want to answer this, or?
Yeah, I mean, we will use e-money, and then sometimes, and I hate to say this, but sometimes we'll use, good old fashioned spreadsheets. We are starting to look into, I think it's called Asset Match now, and we are starting to evaluate that in the office. But I don't see some of these programs caring as much about the beneficiaries, sort of taking all the technology and applying it. So we end up doing that more informally with, generally speaking, with spreadsheets. I don't know, Jeff, maybe you've seen a more robust program that, I'm sure they're out there, but. Yeah,
Apprise Labs now is the new venture from the guy who created eMoney. That yes, there's some more more planning that would be tailored towards high income folks in that. But overall, yeah, there's no great solution for beneficiaries. The thing to keep in mind is effectively, even if you know everything about the beneficiary and you know everything about your client, you still may have two completely different plans, right? Because some clients are like, look, yeah, I know my beneficiary might pay more taxes if I do this, but I don't care. No one left me anything. Whatever I leave them is going to be more than someone left me. If they have to pay taxes on it, it'll be a great problem for them to have. They'll have to pay taxes on a lot more money than I ever got. And the other person in the same exact financial situation might look at it and say, gee, if I could save my, I've been saving my whole life. I don't want any more to go to the government than has to. If I could save my, my kids some money in taxes by doing something now, let me know. So a lot of this comes down to you've got to know a lot about your beneficiaries. You know, what's their income look like? How long do they plan on working for? What are their future? It's like, it's basically doing two plans and merging them together. And then from there, even if you do have that, you've got to take into consideration the owner's attitude towards what they are willing to or not willing to do. But like, look, certain things, like I've advised some clients recently to gift up money, right? Mom and dad had large traditional IRAs, 401ks, et cetera, not a ton of cash to pay for the conversion. Mom and dad really don't need all that money. They're not going to spend it. They have lower income than the kids who are, successful, in most cases, white collar professionals. And what do? Well, the kids gift up the money, say, here, mom and dad, convert at your lower rates and leave me back a Roth IRA as opposed to leaving a traditional IRA. So you could do that. Is there a program that I know of that does that really well? No, it's going to be just simply like, hey, I know you're at a 22% rate. Your kids are at 37% rate today. What can we do to take advantage of this arbitrage? And but it is largely extra financial planning software right now. It's outside of it.
Okay. Let's see. Got a few more questions that have come in. Chuck is asking, if a person turns 72 this year, can they delay the first RMD to before April 1st, 2022, and then take age 73 RMD before RMD?
I'm assuming that means like take the first RMD is this year. They turn 72. Can they take their first one by April 1st of next year, and the second one by December 31st next year? So take none this year, take the two next year, like you normally would. The answer there is yes, you can. Yes.
Okay. So, okay, let's see here. Okay, another question from Scott. Going to a long one here. Let's go. If the intent to equalize the tax benefit of retirement contributions across income tax brackets is implemented as an income tax credit, would that be limited to employee deferrals, or could that be even extended to employer contributions on behalf of employees as well?
It's a good question. It's not part of the proposal to extend that to employers as well. And likely that's unlikely to happen, since implementing a credit like that at the employer level would be much more challenging. Remember, at the employer level, you're just simply calling this an expense of the business. And so if we got into a pure credit there, it would be very challenging, especially when you look at how S corporations and pass-throughs would implement that versus C corporations, et cetera. So it hasn't been proposed. It's possible it could, but I don't see that happening. I think that would be limited to the personal income tax side only. And it's a great question. Thank you.
Yeah, I mean, basically, it's two different things. It's really what it is.
Mm-hmm.
Okay, let's see here. Will all of the Trump tax brackets likely be altered under Biden, or just truly the upper over $400,000 like he stated?
Depends what you believe. And look, even if you say, I 100% believe that the Biden proposal is exactly as President Biden wants it to be, that he wants a 400,000 bright line. He doesn't get to make that call. At the end of the day, tax legislation is going to come up from the Congress and be presented on his desk. Now, does he have the biggest bully pulpit out of everyone to try and muscle his provisions in and what he wants? Of course. But at the end of the day, it's going to be Congress that has to move this through first. And I think if you're not likely to see big increases in the tax brackets at the lower end of the spectrum. If you see changes at all, it's likely going to be reversions from the Tax Cut and Jobs Act. So maybe you could see the 12% bracket go back down, go back up to 15, but it might be extended higher a little bit, and you're going to get a little bit bigger credit here for child tax credits. So, on average, do I see lower income individuals' tax rates rising? I don't. I think if you're below 400,000, I think you're probably pretty safe. If you're above that, the question is, will their cutoff be at 400, 500, 600, a million? Like, what will that that ultimately look like? But I'd say certainly at the lower income spectrums, the 10, the 12, the, even the 22 and 24% brackets, I think you're largely going to be okay. Wouldn't expect too much. Doesn't mean they can't change, but the net effect of those changes is not likely to impact your client much. Consider, for instance, they're looking to have a increase in the child tax credit of $3,000 from $2,000 to $3,000. And then for children who are under 6, so pre-kindergarten, where daycare is needed more, $3,600 per child. Well, all of that costs money. But if you and would lower someone's tax bill, if they were in the, if everything else stayed the same, you could also raise their tax rate and increase their credit and come out with a net neutral. So it's difficult to say exactly what this would look like. Right now, we have a wish list, and that's what we're working off of. It's the best we have, so we'll use it. But once we start to see like draft legislation floating around, that's when we're going to get a much better sense of what may actually have legs to make it through Congress and where those cutoffs would be.
Okay, so we are at an hour. So we are going to wrap up here pretty soon, but I do want to make sure we get in Reginald's question because he actually submitted this before the event, and he's been waiting very patiently. So Reginald is asking, I have a client who is in his 70s, still working because he likes to, but he doesn't need or want the income. He wants to be able to give away 100% of his income to charity. I've read that taxpayers can gift away 100% of income for 2021. Is that AGI? So if his salary is $100,000, $50,000 Social Security, and his investment income is $250,000, can he gift $400,000 this year without any underlying penalties or issues?
So the answer is yes. If his AGI is that high, he can gift up to 100% of it. But just because you can doesn't mean you should. And even if he wants to give it all this year, the ability to deduct up to 100% of your income tax, of your AGI rather, is an election. It's an option, not a requirement. And I would put forth that that individual may not want to actually utilize the benefit. It sounds great for altruism and promoting it, but it's actually really lousy tax planning in most situations to offset 100% of your AGI using charitable deductions. And if you want more on this, I don't know if Reggie knew this or not. Maybe he's just setting me up to say this, but if you want more on this, I just published a very lengthy article on this yesterday. If you go to www.kitces.com, that's KITCES, www.kitces.com. And in fact, maybe Doug, if you're able to do so, if you just go there real quick, you can type that link into the chat panel for everyone. It's a whole article on giving away to charity. And look, the short answer is you can do it, but it's probably not in your best interest to do so because look, if you're at a high income tax bracket, you're not only offsetting income then at like 24% and 22%, but also your income at 12% and at 10%. And that's probably income you do want to pay tax on. You're probably better off actually spreading that tax liability over 2 years. Spreading that deduction out over 2 years and making sure you're offsetting the highest income that's taxed at the highest rate rather than using 100% of the AGI limit to offset all of your income that's both at the high rates and at the low rates. So thanks for teeing me up for that question. Appreciate it.
And
All right, Doug, let's get this one last one in here.
Yep. Okay.
Is the tax on the sale of the principal residence on the chopping block.
Mm-hmm.
I've seen nothing on that. Okay, so just throw that out there. I've seen nothing on that.
And Debbie, somebody is asking for your email. Victor is asking for your email address again. And Victor, I did put the link to Jeff's article in the chat there. You should be able to just click for that to come up. But Debbie, your email?
dtaylor@taylorfinancialgroup.com.
Okay, great.
So Debbie, I just want to, I know because somebody emailed me once about this, just to be specific, she's saying D like Debra. Somebody emailed me once. I was like, I'm trying to get a hold of Debbie. I keep emailing the Taylor, like THE, the Taylor at taylorfinancial.com. She's saying D like Debra Taylor.
Thanks, Jeff.
Yeah. I got that. I was like, no, that's not what she's saying.
Okay, great. So we are out of time. So Debbie and Jeff, I want to thank you guys for giving your time here and answering these questions. You guys are just a phenomenal resource, and it's just a pleasure to listen to your expertise. So thank you so much for joining us today. We
Doug,
appreciate
one
it.
last thing. If anybody's
Yeah.
still listening, Debbie and I, if you like questions and you want to learn more about this, just remember Debbie and I have a course we're beginning to teach it next Monday, the Savvy Tax School. So if you want more of this, more on all the Biden proposals, more on tax planning, more on how Debbie implements stuff into her practices, to our practice with her form letters and all that sort of stuff, let us know. I think we still got some room in the class for next week. It's a virtual course. It's Monday through Thursday. And we'd love to see you there. Debbie and I love answering the questions and seeing your bright and shiny faces in class. So thanks so much for joining us, and we'll see you real soon.
Thanks,
Bye-bye.
everybody.
And the link to that workshop to find out more is horsesmouth.com/tax virtual. That's also in chat. So, okay, great. Thanks for
Thank
joining
you
us.
all.
And I will be making a replay of this available to you. We always get asked that. So yes, we'll make that available to you. Okay. Thanks for attending, everybody.